All right, well, let's welcome in Ed Yardeni, President at Yardeni Research, with what he made of things over the last few sessions. Ed, good morning. Great to have you with us here, and thanks for joining us, as always. Should we pay any attention to people like Bostic, etc., last night saying, well, they'd prefer a pause in November? Or you think we should just go with the broad thing that rates are now headed lower? Maybe the first one was the deepest, but we are going to get cuts over the next many months.
Yeah. Well, I'm kind of biased, quite honestly. I'm predicting none and done. I'm predicting that the Fed is done for the rest of the year, that there will not be a rate cut in November and December. And apparently, from what I understand, that's a fairly contrary position. But I was therefore delighted to hear Bostic realistically state that maybe there won't be a cut in November. Simply put, the economy is doing extremely well. The economy has actually been quite hot, and the risk is that the Fed is heating up, overstimulating an economy that's already doing quite well. And the other area of agreement with this outlook is the bond market. The bond yield has increased from basically 3.6% when the Fed cut by 50 basis points to over 4%. So the bond market, too, seems to be signaling that maybe the Fed is too far ahead of the easing curve here.
Okay, none and done, at least for this calendar year. Mr. Yardeni, morning. So how many next year for calendar year 2025 in terms of rate cuts? And secondly, your expectation from the press briefing tomorrow in China?
Well, look, I think that when it comes to rate cuts, I'm pretty comfortable with the rates are where they are right now. The reason I'm comfortable with that is because the economy seems to be comfortable. It's, as we know, the economy has been growing about 3% at a annual rate over the past few quarters, and a year-over-year basis is up 3%, and that's without any decrease in interest rates whatsoever. So I don't really have a problem with this level of interest rates. But as you pointed out, the Fed does seem to be committed or wants to lower interest rates. They have this idea that there's some sort of neutral interest rate that is lower than where we are today. In their summary of economic projections, they seem to suggest it's 2.9%. There's no way to get an accurate assessment of what the magical neutral rate is, but I would say it's higher than that, maybe 4%.
Hi, Ed. Good morning. Good to see you win. Ed, if you're not going to get any more rate cuts, if you're right and bang on and, what Bostic told us overnight as well comes through, then what about the equity markets? Because the global equity markets are clearly factoring in rate cuts that are coming in there. So how do you expect global equities to react?
Well, remember at the beginning of this year, the markets were expecting 6 to 7 rate cuts. We didn't understand that, and we were talking about maybe 2, maybe at most 3 rate cuts. So far, we've had one that was the equivalent of what the market expected would be 2. We had 50 basis points instead of 25 basis points. And the market's at an all-time record high, notwithstanding the fact that, the concern was that the economy might be weak and we would need many more rate cuts. I mean, this is not a bad trade, right? To get better than expected economic growth and sacrifice lower interest rates, the market can live with that. That's better earnings, and valuations are already stretched. I don't think we really need interest rates to come down and push valuation multiples even higher.
No, I mean, Ed, I think you've got it. You've been contrary all year through, and you've been right. I think in this beginning as we came in.
So far, so good.
Absolutely. And as you said, I mean, you are. It's against consensus, not consensus at all. So you're in the non-consensus zone, but you got the bond market which agrees with you. So I think that is what matters.
It does. Yeah.
So we'll see. But thank you very much, Ed. Great to speak with you.
My pleasure.
And appreciate your time
here
on CNBC-TV18.